Good Wednesday morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Dimitri, myself, or Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer. And there you go, D. Good morning, my friend.
Good morning, Will. How are you?
Good.
Good morning, everyone. Let me share my screen here.
Yeah, before we got started, I think there was one other question that was out there from Michael McCrae about SPY and looking over a series of days. And we try to get to as many questions as we can. And you informed me that that is going to be on a webinar that we're doing with IBKR next week, correct?
Yeah. So there was a question, and it had to deal with what the performance of a straddle or the expected move in the beginning of the week to the realized move by the end of the week, and that because I will be covering that question within a webinar this coming up Tuesday. We'll just leave it. We'll just leave it for that. So we could spend some time looking today at something different since we're already going to cover that question. But in that webinar on Tuesday, we're going to be talking about tracking the performance of straddles, option straddles, from different perspectives, and how you could use those to measure the implied volatility, implied moves versus realized moves, as well from a historical perspective. So, on Tuesday, we're going to be discussing that with Interactive Brokers. You have to register with them. They're going to be hosting it. It's free, but you do have to sign up to go and watch it live. So thanks
Well,
for
actually,
that.
you don't necessarily have to, you just have to register on IBKR's site. And if you miss it, I think they send you a link so you can watch it. And they do store them on their library. I'll also put the link to the IBKR library because Dimitri's done well over 30 webinars with IBKR over the last couple of years. We do one the second Tuesday of every month at 2 p.m. So just click on the link to register. I'll also put a link once I find it to the library, and you can go look at all of our old episodes. But you do have to register on their site to see it, and they control the webinar. So with that, let's get started, D.
Yep. Thanks, Will. And I think today we're going to continue on our conversation, analyzing implied volatility skew. A couple days ago, we looked at a graph in SPY that measures skews from one type of perspective. Today, we'll look at a couple other graphs that could help us just visualize what the skew looks like. So to get to that page, if you type in up here the symbol you're looking for, you will come to a summary page for that stock, just like this. And on the left-hand side, if you click on volatility on the menu and then select skew, you will come to this new page that analyzes the implied volatility skew. In this case, I typed in SPY, so we're going to be looking at SPY. Let's close this menu to the left-hand side to expand our screen. And we talked about this tab that it defaults to, which looks at the 25 delta put implied volatility minus the 25 delta call volatility, to measure the skew, how much difference is there in the implied volatility between those two types of options. And then we could graph it over time to see, it's high points, low points for the year, average, and where it is currently, to get that perspective. So let's go to the next tab since we already discussed this. IV skew by delta. And here it quickly shows us three uh, three lines. Okay. And these are implied volatility skew, like the entire structure or curve for a 30-day constant maturity option. So what this is doing is when we measure implied volatility and try to track it, we have to define, well, what are we looking at? Because implied volatility, it's a derived value. It's derived from option prices. In option contracts, we have different expirations, we have different strikes. So we have to define what implied volatility we're looking at. So this one is a 30-day constant maturity. So we use a methodology similar to like the VIX to get a 30-day implied volatility. And not only that, the money, we're looking at the structure based on the delta of the option. Okay, so here you could see this green solid line. That's the implied volatility of SPY, the latest one, the most current, that's graphed based on the delta of the option. Okay, so what it will do is look at the money implied volatility, run a straight skew or a straight implied volatility through each strike to figure out the deltas, and then looks at those and marks the actual implied volatility. So here we could see the middle, that's the 50 delta at the money right here. And then going to the left-hand side, right? These are kind of downward strikes because these are called deltas. Okay, so as you go to the left, the in the money calls have a higher delta, and it will be out of the money put. And then to the right-hand side, these are out of the money calls, right? Because the deltas are dropping. So here we just represented it as call delta, where it just, if the put delta would be the opposite. So now we could kind of see that this is a downward sloping skew as you move higher in strikes, or as the deltas of the call options go lower, right? And maybe there's like a little bit here of it on the tail where it comes back up. So downward sloping for the most part. So now that we have the most current one question that we could be asking is, well, what's the historical average, right? Like, if we took the daily observations for this line, and we wanted to see where is the average implied volatility smile. Okay, let's call it the implied volatility smile or vertical skew. Are we below that line, above that line? Are we crossing that line somewhere? Did the skew shift? Did the line shift? Did the tails shift? Did it flatten out, get steeper? So how do we know if we want that question? We could plot that line on the same graph and compare the two lines, right? So instead of like just two implied volatilities, we're comparing the entire line, and that's what this line down here below, so this 52-week average, this dotted like brown line, that's what it's showing us. And another question that this graph answers is, well, how did this shift on the day, right? So on the day is like, if today's trading, where did this line move to? Just like we're tracking a stock price. Well, if we want to see a change, we're going to compare it to the previous day, right? So today it's trading, higher, lower, by how much? So that's the reference price. So that red dotted line up here, that shows us where that line was the previous day. And now we could see where it landed currently. So far we're closed today. So this is yesterday's close. So this will start updating later on in the day, once new data comes in. But what the takeaway here is, the whole line looks like it shifted down from this red dotted line to this solid green line. So that's on the day. The entire smile just shifted down, looks like proportionally, right? So it really, at least to the naked eye, if I'm eyeballing it, it looks like it moved down proportionally along the curve. Just implied vols came in. As far as the 52-week average goes, that's that dotted brown line. It looks like on the day we came closer to it, right? So from the red line, if we look at from the red line to the green line to the brown line, we did start moving closer back to that 52-week median, or sorry, the mean. That's the average, the mean. We're above it, and the monies are still above it. The tails, or the wings, let's say the wings and the tails to the downside still are skewed a little bit higher than the 52-week average. So we got the monies and the out of the money downside, right? Because keep in mind, when the call deltas, these call deltas are in the money, right? So these are downside strikes. And it looks like the upside actually fell below the 52-week average. So all the way over here, if we look at those wings and tails, even at the 25 delta, we're kind of looks like right there, right? We're right at the average. And then as we go up, those tails to the upside actually fell below. So the takeaway there is implied vols yesterday started to kind of revert back to that 52-week average. Looks like the upsides actually, probably had a lot of maybe buy writing or some kind, because they fell actually below that 52-week average. So the upside looks like it got hit pretty hard relative to the other strikes, and the downside still stayed a little bit more elevated than the average, and so did the at the money. So as far as like the at the monies and the downside, still were there below the average. So the demand there was still the demand for those options were higher relative to those upsides. Okay, so do you guys see that? How hopefully that graph just kind of makes that point. Okay, so you see here the green line crossed below that dotted brown line, while these stayed above. Okay, so that's the kind of quick takeaway to get a sense of what that 30-day constant maturity vertical skew looks like. Um, since we have a couple more minutes, let's look at this one more tab. And then, we'll get to these at a different date. So here, let's say we come out and we want to look at a particular expiration. And let's say an SPY, I don't know, let here Feb 25, traded 224 contracts, 224,000 contracts. So let's click on this. And and now this is looking at the actual expiration, right? This is not the 30-day constant maturity. I'm looking at the actual expiration. And here I'm looking at the implied volatilities by the available strikes, okay? And now I see two lines, okay? There's a blue line here, and that is looking at the current implied volatility for each of those strikes, okay? And I could see, yes, this one's also downward sloping, right? And you could see that where that blue line is. And then I got this red line, and the red line allows me to compare where these implied volatilities were historically. So the first line here is from yesterday. So now I could see, yes, February 21st, the implied volatility dropped in the entire volatility smile, right? A little bit more on these upside calls, around the 620 maybe and higher. And it dropped across the board, but not as much to the tails. Okay, so those upsides got hit harder than the downside. What if we wanted to go back a little bit further? Say, well, how did this look a couple days ago? So this is what we could do, is drop this down and look at today. So it's going to compare the blue line, and let's say, what did it look like? Let's say January 28th. Now I clicked on it. Okay, so you could see here on January 28th, it redrew. The blue line is still, where it is last, but this red line shows us that on January 28th, it was lower, right, than the current line. You guys see that? So this is where it was before on January 28th. That's where the red line is. The blue line is still our reference point for where we currently are. Okay, so from January 28th to now, implied volatility went up, right? It went up, a little bit across the board, not as much on the upside. So on the upside, like here, we're basically the same. But if we fast forward to February 3rd, you could see a different story. All right, so that's a quick way to look within the expiration and look at the implied vols along the vertical smile skew, and go back and start comparing it, if how that evolved throughout the day. So if you have like a particular date that you were looking for and you were wondering, hey, what was it like this date, and how did it move, you could actually just go like that day by day, okay, and see it. So I'm gonna stop right there, because the next tab will probably take us a little bit longer, but we'll continue on looking at different ways to visualize the implied volatility skew.
That was awesome, D. We did have Michael McCrae came in, and he had asked that question about looking at different time frames for information. And as we stated earlier, you'll be having a webinar with IBKR, next Tuesday, 2 p.m. The link is in the chat for everyone. You have to register on Interactive Brokers website for all their webinars. I also put a link to all the webinars we've done, because once they're completed, you don't have to watch it live. You can go to their library and find all the webinars that Dimmitri has done with Interactive Brokers. So great stuff, D, as always. Thanks everyone for joining. Remember to like and follow us on YouTube. Great job, buddy.
Thanks, everyone. Stay safe out there. Have a great trading day and hope to see you tomorrow.
Trading